Pratik Gupta is our market master there, CEO and co-head at Kotak Institutional Equities. Pratik, good morning. Good to have you back on the program. Thanks very much. The question to you is, of course, to assess the color, the intensity, flows, and what should we expect from here? Because yesterday, foreigners net bought in the cash market after some time. Do you think we've seen the worst of all of the selling, and whether we should expect sort of limited selling, if that, or maybe even some buying from here on? What's your sense?
Hi, good morning, Prashant. We think yesterday was more of an aberration, more due to short covering rather than real long-only global active funds coming back to buy India. I think at Kotak, when we speak to most of our global investors, they're still very, very cautious. Most of them are seeing they still see India as quite an expensive market, trading at 20 times FY26 earnings on the Nifty, trading at 100% premium to the MSCI. And more importantly, India is a growth market. People come to India for growth. And growth is where I think we've been disappointing last few quarters. And even the outlook going forward isn't that great. We're at Kotak, we cover almost 300 stocks, and we're more worried about the risk of earnings downgrades rather than seeing any strong case for earnings upgrades in the short term, at least. So the long-term structural story in India stays intact, but most foreign investors are seeing money going back to the US. And this Trump tariffs and trade wars are actually just injecting a lot more uncertainty, flight to safety, which is back to the US dollar. So until we see signs that the US dollar is weakening, until we see some noise around this trade wars sort of coming off, I think we will continue to see foreign selling, and the market will continue to be driven more by local flows. So sort of you may see a tactical bounce, but otherwise we're still advising a cautious stance on the markets right now.
Okay, cautious in the market right now. By the way, I'm just sort of updating, since I was talking about Asian Paints earlier, it's not just CLSA. A whole range of brokerages. There's almost an overwhelming consensus on the way down on Asian Paints, and something like a Jefferies as well has lowered the target. Jefferies is now at 2,000 on Asian Paints, and most of these targets are running well below the current market price as well. So it seems the pain is playing out. But Pratik, let's actually, have a broader discussion on consumer, because it's very clear that there is this personal income tax bonanza that's come our way. The question is, how can it be captured from an investor standpoint? What kind of stocks would you look at? For instance, would you look at buying into weakness in a stock like Titan? I know you won't name individual names maybe, but in general, how would you play the consumer where you see some element of growth and some element of valuation comfort as well?
So I think the main point is the valuation comfort, which you highlighted. That is still not there in most of the consumer stocks. And despite this tax bonanza in the budget, just keep in mind that this amounts to barely 0.3% of GDP, and not everybody who gets that extra 1 lakh rupees or whatever tax savings, they're going to spend it on consumption. Some of that money will be saved and invested and so on. So it may not necessarily flow into consumption, although nonetheless, this is a good step. This will result in some boost. But we think it's unrealistic to expect that the top 5% or 10% of the population, which is really who will benefit from the tax breaks, they will start buying more of soaps or shampoos or buy more milk. In fact, we had Nestle's results yesterday, and Nestle's more in the premium staples category. But even they were highlighting what the weak demand environment. You saw Asian Paints again pretty weak. So we think it'll be the low ticket, small ticket discretionary items which will benefit because staples, I don't think you'll see a demand boost. On the other end of the spectrum, we may not see a demand boost for let's say, high-end discretionary items like jewelry, etc. I think it'll be more the low-ticket discretionary consumption. It could be QSR, could be mid-size, mid-class hotels, small tourist type of. You could see a pickup over there. But overall, I wouldn't read too much into the budget boost. We are still going through a weak growth phase. The jobs addition is still low. The quality of jobs and the wage growth is still quite weak. So we think we are more at risk of seeing downgrades in most consumer stocks earnings over the next 1 or 2 quarters. And therefore, we'd still be somewhat cautious on the overall consumer SPAC.
Hi, Prateek. Good morning. Good to see you in. Prateek, what about these OMCs? It's not the one for the faint-hearted, but the stocks have corrected big time. Crude oil prices was being volatile. You had the LPG subsidy as well that wasn't as much as expected. And those stocks have seen a sharp correction. However, this morning we have Goldman Sachs has come out with the note, and they are saying that they believe bulk of it is in the price. Your view on the OMCs?
So I think it partly depends on your view on the oil prices. So there we think oil prices will stay high, which is why we actually prefer more the ONGCs of the world rather than the OMCs. The OMCs are also subject to all kinds of regulatory intervention. There's a lot of heavy capex going on as well. So from a free cash flow perspective, these and the ROE, sustainable long-term ROE perspective, we are still quite worried. These are more like trading stocks, the entire oil and gas pack. But at this point in time, instead of the OMCs, we prefer ONGC at this point in time.
Got it. What about a couple of those other sectors that did very, very well when the broader markets were doing well? The renewable energy space, solar themes, they did very, very well. And they have seen a fair bit of a pullback from the top. What's the view on this theme? How do you play it?
So the solar theme is pretty interesting. We think there's tremendous long-term growth potential, but I think you got to be careful. We prefer the asset owners, the ones who are actually, you've got IPP contracts and building out solar plants, rather than the modules and the cells providers. There we think competition is likely to come in. There's a lot of capacity being put up. So in the next 1 or 2 years, you will see strong growth from those guys as well, but that's more than reflected in the price. I think the longer term story is going to be in the asset owners. And I'll just name one stock where we actually did an IPO some time back, and that stock's come off below the IPO. That's Acme Solar, for example. That's something, those kind of companies will do relatively better versus the solar and module providers. And then you have the integrated existing incumbents who are getting into solar, the existing thermal players, they're also getting into solar. But there we think valuations are still somewhat extended and there are pretty significant issues in terms of execution capabilities over there as well. So again, you got to be a bit more stock specific. You can't say, okay, the entire solar space is going to do well, so let's buy the entire pack. I think we'd recommend being a bit more cautious and look at valuations as well.
Okay. By the way, just looking at more active stocks this morning, and Angel One is very interesting. Angel One, let's pull up the stock. It's zooming up almost 6% higher. The monthly update has come in, and our colleague Vamakshi points out an interesting trend that the client addition is a little subdued. Month on month, client addition is actually down about 15%. But guess what? Volumes have started picking up. The average daily turnover, that's increased 6.3%. So it seems the market wants to believe that the worst of this change in F&O norms, all of that impact is now, played out, and maybe some semblance of stability gets back in. Prateek, so that question to you, the business that you're in, capital markets. The stocks have been such high flyers, right? The stars of 2024, but then we got into this patch where the market's not doing anything, regulations getting tougher. What do you think of them now? And if you were to play a capital market story, what would it be? Would it be brokers, wealth managers, mutual fund companies? How would you look at it? Exchanges, of course.
Yeah. No, exchanges, I think generally are a good play. You saw the NSE numbers yesterday. But I think off the lot, I would say the AMCs or the mutual fund companies are probably the best bets. They have corrected quite a bit, 20-25%. In fact, today we've upgraded some of them. We had negative ratings on them until recently, but given the stock price correction last few months, we're turning a bit more constructive. I think the structural story is quite intact in the case of the AMCs. Firstly, you've got a growing savings pool in India. Second, more and more people coming into the equity markets. And third, these AMCs improving the distribution networks, coming out with more products, getting into passive themselves, passive funds as well. So we think valuations have now become a lot more reasonable, ranging from 20 times to 27, 28 times for fairly attractive, 15 to 20% earnings growth over the next 3 to 5 years. And with very strong ROEs. And the worst of the regulatory environment in terms of all kinds of changes in the last 1.5 years are behind us. Brokers, on the other hand, I think are more vulnerable. Depends on and the jury's still out in terms of what the volumes will be in the coming year. They're more dependent on the volume outlook. Also, regulatory changes over there are likely to remain adverse. So we prefer AMCs of the entire pack.
Okay, AMCs is your pick of the lot. Got it. Prateek, thanks very much. Good having you on the show today, and thank you for all the perspective. We look forward to the next call soon.